There is a high risk of recession in Australia, but we put it probably at about 40%.
With soaring prices, rising interest rates and real wages going backwards, we haven't felt this pessimistic about our household finances since the global financial crisis.
Are you feeling cost of living pressures though yourself?
Yeah, definitely. Everything's more expensive.
I'm basically paying like $2,000 more every month.
It's getting expensive, especially the rent.
As Australians cut back on spending, more people will lose their jobs.
I do think it would be possible to get a big enough lift in the unemployment rate such that things felt a bit more recession-like.
8 interest rate hikes in 8 months. With more to come, is the Reserve Bank at risk of tipping Australia into recession? On this Business Summer Special, we ask, can the economy escape a global downturn? What are households in for, and how should investors prepare? First, I'm off to meet Jean-Bei Liu from Tribeca Investment Partners. Hey, Jean-Bei,
Hi, Alicia, really nice to see you.
Jean-Bei Liu manages $1.1 billion in the Tribeca Alpha Plus Fund.
Where are you going to put your money in 2023?
Look, 2023 is going to be a very, very interesting year. We think the first part of the year, perhaps around the March quarter, we will see a little bit of volatility. Things will get tougher. US companies will start downgrading earnings, and even Australian companies will downgrade earnings on the back of high costs and slowing demand. However, heading into the latter part of the year, we think the year will look better. Just simply the analyst downgrade is already sort of put into the numbers, and the interest rate increases will stall by then. So things should look pretty good heading into Christmas next year. So where do I put money? I think stick to the defensives. I think the best sector to put your money in is probably healthcare. Healthcare are the sector that the earnings is going to grow regardless of what economic outlook is going to be. Particularly some of the healthcare companies such as Ramsay, such as CSL, their earnings were actually hurt by the pandemic because of shutdown in elective surgery as well as the blood collection in the case of CSL. And these companies will actually grow much faster than what they used to grow at. Now, there's a few other things will do well. Your normal defensives such as Coles and Woolworths will do okay. Price inflation normally pretty good for them to put through the price increases. Every other sector, you have to be very careful in terms of where the earnings might go, because when things slow down, the earnings will get downgraded. And when there's earnings that get downgraded, share price doesn't go up. So these are the sectors when you think about the banks, you have to be a bit careful because economic growth is going to slow down. Their margins, even though March will be pretty good, but they will start to stall as things slow down somewhat. You have high bad debt and consumer slowing down across the corporates as well. And then the industrials that's linked to economic sensitivity sector, things like consumer sectors, like consumer discretionary, we're just not going to buy as much stuff as we bought in the last couple of years.
And speaking of one sector you haven't mentioned, and that's the resources. Obviously, China's starting to open up. Is it still a good time to be exposed to the resources sector?
Absolutely. So resources will continue to run for the time being as the headline out of China continue to say they will continue to reopen and things look good. Now, however, the resources earnings you have to be have to watch out for, because China, even though it was in lockdown and things, they have continued to purchase a lot of commodities. The iron ore, the copper, and there's a lot of things they continue to purchase, and they continue to build up their stockpile before the Chinese New Year. So in a way that commodity prices and commodity companies have rallied pretty hard on the good news flow. I'll be very cautious for them for the next 12 months. Globally, economic growth will slow down. Commodity never outperform in the slowing environment. This also includes energy companies. Energy financials don't outperform during a global slowing environment, and there's a lot of those short-term supply issues that are causing the spike in the oil prices. So you need to be very careful across those sectors. Particularly, they have done very, very well.
Broadly, in these uncertain times, quality tends to outperform. Even if stocks are expensive in those blue chip names, would you still look at them?
Oh, absolutely. So the quality company always does better in these sort of uncertain environments. They have pricing power. They can push through high costs. And generally, these are the large blue chips. Smaller companies, much harder to push through price costs. And that means their margin will be under pressure. That means earnings will go down. So stick to quality. And secondly, quality companies tend to be able to grow in this environment. They normally have the growth driver that is very unique to them, whether it's just the product that everyone desires or whether they have certain competitive advantage.
There are quite high expectations that the US will fall into recession. What does that mean for the share market?
Look, for the US share market, it will probably stall as it has underperformed in the last 12 months. NASDAQ will continue to struggle because NASDAQ is dominated with consumer stocks. So consumer slowdown is going to be very, very severe. And for the rest of the market in the US, it's going to be very tough. Now, Australia is different. Whilst we do have a lot of company export to the US, but China is a big component of our earnings. And it's very likely China in the next 12 months will go through its reopening. And if based on the current relationship between Australia and China, it is thawing somewhat. We do think that our market would continue to do better than the US.
Sean Bailu, always great to get your insights. Thank you so much.
Thank you for having me. Thank you.
The economy risks grinding to a halt in 2023 as budgets get squeezed from higher loan repayments. The Reserve Bank thinks it will grow at a snail's pace of 1.5%. But is that optimistic? Some believe the risk of recession is growing as the global outlook deteriorates.
I'm here at the headquarters of AMP, where I'm going to get more insights from Chief Economist Shane Oliver. But first, here's Rachel Papazzoni with a look at what happened in 2022, including how Russia's invasion of Ukraine exported higher prices around the world.
Ukraine is a nation at war after Russia launched a full-scale invasion of the former Soviet state.
As heavy fighting continues on the Eastern Front, Russian forces are raining artillery fire on the southern Kherson region.
Russia's invasion of Ukraine on February 24, 2022 not only led to a devastating loss of life, it set the global economy on a path no one saw coming.
That has been clearly very damaging in terms of the supply of raw materials, of fuel, particular oil, and that's just generated substantial inflation and cost of living pressures around the world.
Higher energy bills impacted Australian households and businesses and led to soaring consumer prices.
This is the biggest challenge to central bank inflation targets since the advent of those inflation targets back in the early 1990s.
Inflation reached double digits in the US and UK. We're yet to see the peak in Australia. Globally, central banks took decisive action.
Most central banks have really been caught out by the pace of the increase of inflation and ended up raising interest rates a lot more than they expected.
The RBA lifted the official cash rate at its fastest pace ever, from near zero in April to 3.1% in December.
The bank will need to do at least another couple of rate rises, so perhaps one in February, one in March.
National property prices began falling in May, with values down 7% to the start of December.
Which is one of the largest on record, and I would expect that as more and more households face the expiry of fixed rate loans from very low interest rates to very high levels, there's going to be more pressure on the housing market over the next year.
While much of 2022 was about numbers that didn't necessarily go in the right direction, they weren't all bad.
The high point for Australia was clearly the reopening of the economy post the COVID restrictions. Once the restrictions were removed, there was a significant upside surprise to consumer spending.
The economy grew by almost 6% in the 12 months to September, while the unemployment rate has hovered near a historic low of 3.5% since the middle of the year.
I think that that's a real testament to the flexibility of the economy and the fact that we were able to bring people into the workforce, more people working, hopefully in jobs that they're enjoying and obviously earning a wage.
As the global economy enters a downturn in 2023, there are a few key themes our experts will be looking for.
If we keep going and spending as strong as we have, it's going to be a lot harder for the central bank to take those demand side pressures out of inflation. And history shows us once you get that embedded, that becomes really challenging, much more difficult for policy to respond to.
I'll be looking out for the impact of the size of the return of migration and the impact that that has on the domestic economy.
I think we're going to see the combination of a tight labour market and government decisions, particularly around the minimum wage being pushed up, means that overall wage growth accelerates further towards where the RBA has been expecting, which is closer to 4% than 3%.
Hey Shane, nice to see you.
Likewise,
really good to have you. So Shane, one of the key determinants of how Australia will perform in 2023 is what happens to the US. Do you think the US will fall into recession?
There is a high risk there, and I'd say it's probably just above 50% in the US. And that's mainly because of the more aggressive rate hikes from the Fed. The good news, though, is that the US, apart from inflation, doesn't have a lot of imbalances. Household leverage is relatively low. They haven't built too many homes like they did prior to the GFC. We haven't had overinvestment in technology or capex. So consequently, if it does go into recession, it's probably going to be a fairly mild one.
And what does that mean for Australia? I mean, there is now a likelihood that we could also tip into recession. What chance do you put on that?
Well, obviously the weakness in the US and probably also Europe is bad news for Australia. Flip side, though, is that as we go through the year, we're probably going to see stronger growth out of China after it gets over its initial spike in COVID cases. I think their economy will rebound. The other point to note is that the Reserve Bank hasn't tightened as aggressively in Australia, and we think they're either at the top or pretty close to it. We've also got a huge pipeline of work yet to be done in the dwelling sector, and business investment looks like it has a reasonably solid outlook. So yes, there is a high risk of recession in Australia, but we put it probably at about 40%. More likely scenario is we get a severe slowdown down to around 1.5% growth, but we manage to avoid recession.
Well, despite that 40% probability that you're putting on Australia entering a recession, you're sounding fairly optimistic. Is there a risk we can talk ourselves into a recession if we're not?
Look, there certainly is. This is just about as much about psychology as economic fundamentals. And of course, if psychology, confidence gets too negative, people will clamour, businesses will stop spending, and consequently we could tip into recession. And that's something we don't really want. So we don't want to get too negative here. Certainly we want to slow down, but we don't want to, say, jump out of the frying pan of high inflation and jump into a severe recession, because that would be a terrible outcome.
Well, the RBA is saying that we'll see growth of around 1.5% in 2023. That is a sharp slowdown from 2022. What's it going to feel like?
Look, for many, it's going to feel a bit like a recession. The jobs market won't be as strong as it has been. We're probably going to see a slight rise in unemployment. Retailers are going to feel a far tougher environment. And I guess that flexibility people have had with their jobs, being able to jump from one to another reasonably easily, will sort of start to fade. So it's going to feel pretty tough. And at the same time, don't forget that many households in Australia will still be struggling under the impact of very high mortgage payments.
With that in mind, of course, house prices are going to be very closely watched in 2023 as well. They've already come down. Where do you think they're going?
Look, I think they've got more downside to go. I think we're only halfway through the slump in house prices. Don't forget the very high house prices we saw in the last year at the start of 2022. That was a function of ultra low interest rates. Those interest rates have now gone. And so new buyers coming to the market can afford to spend on a new house about 25% less than they could have a year ago. So that means buyer demand is far reduced, and at the same time you're going to see a bunch of homeowners who will be struggling with their mortgages, particularly those on fixed rates who reset to much higher rates, and that could result in some increase in selling. So I think there's more downside to go. I think the top to bottom fall in total will be about around 15 to 20%, and Sydney will probably be the worst of the lot. At the other extreme, you've got Perth and Darwin, who probably won't see much downside at all.
How are households going to cope with these higher rates?
Look, I think many households will struggle. There's a group of households out there who have their mortgages well under control. They've got great buffers. They're okay. But it's mostly the younger buyers, people who've got in more recently, often with a family, struggling to make ends meet. With those high mortgage payments already and high debt levels, they're the ones who are going to have most difficulty. And I think that could result in increased defaults. Not a lot of them, but I think we'll see a bit of that coming through. But I think it will certainly lead to less spending power in the economy as those people have to cut back spending elsewhere.
Shane Oliver, always great to talk to you. Thank you so much.
My pleasure, Alicia.
And that's all from this Business Summer Special. For more on our stories, you can head to the ABC News website or catch up anytime on iView. I'm Alicia Barry. Thanks for watching.